Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 31st of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, the US and China agreement to stabilize the economic relationship. How could that go wrong? But first, Neil's out, but I'm happy to say that Stephen Brown, our Deputy Chief Economist for North America, is with me to walk through the week's other big news. Happy Halloween, Stephen.
Happy Halloween.
How scary is the Fed's current dilemma? That's my kickoff question to you. It's driving through what Jerome Powell calls the fog of a government shutdown. They don't have the data they usually rely on to calibrate policy. Inflation's still above target. The labor market seems to be weakening. And then you've got this president who wants much, much lower rates. So how scary is it for the Fed?
I don't think it's too scary, which is part of the reason we got this a bit of a surprise, more hawkish tone from Chair Powell during the press conference. So obviously, due to the government shutdown, we do have a limit of data, but we have an awareness of kind of some of the alternative data points. Obviously, we did get September CPI. And I think the point is that the data maybe aren't quite as bad in either direction. So the September CPI data showed a smaller rise in core prices than we expected. Again, some evidence of tariff effects, but those were offset by effects elsewhere that kept core prices rising by just 0.2%. So certainly nothing to be too concerned about. Now, annual core inflation is still 3%, but it didn't rise in September as we and most others expected. So suddenly the kind of more hawkish members don't need to be quite so worried about the inflation picture. On the other hand, the more dovish members, so obviously we haven't had any payroll data since the August report, but we have had kind of alternative indicators from the ADP. They were weak for September, but then ADP have started releasing a new weekly kind of rolling average, which only goes up to early October, but is already looking more positive. So showing positive payrolls growth again by their measure at least. So it doesn't look like the labour market's worsening any further, but equally it doesn't look like inflation's rising any further. So I don't think there's a clear steer to either group here, which is why there's all this uncertainty about whether the Fed will cut in December or not. So kind of just to recap, the 19-member FOMC, essentially 10 of them thought that there should be 3 cuts this year, so including one in December now, and the other 9 didn't think they thought there should be 2 or less. So it's a very fine balance. But we still do think they probably will lean towards December because within that 19 members, only 12 of them are voters, and the 12 voters appear to lean a bit more towards the dovish side. And I think the fact that they don't have any data just makes them a bit worried that they might be missing weakness in the official labour market data at least.
So we had that meeting on this past week. We had the decision, 25 basis point cut, pretty much expected across the board. But then you look at the details of which way everyone voted, and there was this dissent in either direction. Stephen Myron calling for much lower rates. I guess his views are pretty well known at this point. A cynic would argue maybe they're not entirely his views, more his bosses down at the White House. But then Jeffrey Schmidt at the Kansas Fed calling for a hold. A lot of coverage about the significance of the fact that you have a dissent in both directions. Is it really that significant?
Not really, to be honest. So certainly when we had Waller and then Bowman dissent earlier in the year, there was a lot of tension about, these are the first dissents since, for many years from governors. But it's actually much more common for the Fed presidents to dissent, and Schmidt is Kansas City Fed president. And typically the board of governors, so the 7 members, because they kind of work more closely every day, they do kind of reach more of a consensus. Obviously, Stephen Myron is the exception at the moment, but we tend to get more dissents from the Fed presidents, certainly over history. So it's not a huge surprise. And certainly, back to the point I mentioned earlier, it looks like the non-voting members, which are basically all Fed presidents, those lean a bit more hawkish. And in general, it does seem that the Board of Governors is leaning a bit more dovish. So I don't think it's a huge deal, but it is interesting about what that could signal for the next meeting in December. So even if they do lean slightly towards a cut, maybe we'll have actually more dissent in the kind of the hawkish direction than the dovish direction.
I mean, I started by talking about the fog that Jerome Powell talked about. This need to drive slowly in fog, take policy slowly as a result, because there is this shutdown. I know you said that, they have had some data, but not as much as they ordinarily would. It's day 31 of the shutdown. We're going to be at a record 35 days this coming Tuesday. How are we expecting this shutdown to proceed? When do we expect the US government to reopen? When will the Fed get the data they need to make a decision? Are they going to have this data come the December meeting?
We're certainly not convinced that they will. So betting markets, betting markets basically show us how uncertain the situation is. It's roughly 50-50 split the last time I looked earlier this week between the shutdown ending in the first half of this month or obviously taking longer than that. The modest consensus may be that it should come to an end by Thanksgiving, because Congress would want to avoid travel disruption around the holiday season. But if it only comes to an end kind of a week before that date, then it's still not necessarily the case that the Fed's going to have much more data. So obviously September payrolls were collected and they can be released pretty quickly, but there won't be an October or a November report as there should have been ahead of the Fed's December meeting if the government shutdown only ends kind of a couple of weeks before that meeting. So it's still going to be driving in this fog, most likely, as it were. But obviously, to kind of stretch this metaphor even further, it would make a lot less sense to take that slower approach if you're also worried about the weather worsening behind you and getting stuck in a blizzard, right? So that was the key point behind the Fed cutting, is that it's very worried about these downside risks for labour market. We've had many layoff announcements this week. And yes, Powell has pointed that statewide initial jobless claims haven't risen, so that data doesn't look concerning. But we know the unemployment rate has been ticking up gradually without any rise in jobless claims, because it's just as much about people struggling to find jobs as it is about layoffs. So I don't think that there's really enough there to really make you encouraged that suddenly the labour market has turned a corner, which is why we think they probably will slightly lean towards a December cut. I think, when we think about how central banks have acted in recent years, we've often heard this kind of line from them that we expect a hike or cut sooner or later anyway. So it makes sense to just do that now if they're not quite sure which way the decision lies at any given meeting.
So if you're driving through fog, keep driving.
If there's a blizzard behind you.
I don't know. I'm going to abandon the weather analogies for now. But you talked about the health of the labour market. You mentioned this ADP data. Prior to the shutdown, economists like yourself had a pretty low opinion of the ADP numbers. How reliable is the quality of the labour market data? How confident are we that we have an idea of what's going on in the labour market? And I ask that with reference to these headlines we're seeing about job losses, most prominently perhaps in recent days, Amazon, 14,000 corporate jobs going there. Taking all of these headlines in totality, looking at whatever is available in terms of the jobs picture, I mean, what are we seeing?
Yeah, I mean, we've certainly made this point in many publications before, right? That the ADP is not a particularly reliable guide to official payroll number. The point we're kind of making there is that in any given month, it's not a good guide. And it has actually become a slightly better guide in recent times to the final official payrolls estimate. But even if it's not a particularly reliable guide for any given month, over time, they do trend together. If the Fed doesn't have 3 months of payroll data that it might have had otherwise at its disposal, then at least it can take something of a signal from the ADP data that it would have in the meantime. So I think it's worth looking at, even if we shouldn't take it. Well, we should take it with a pinch of salt. And then certainly we do have, as I mentioned, the kind of a statewide initial jobless claims still being collected. Those look absolutely fine still. But some of the survey data is still weak or weakening a touch. So, for instance, we have in the Conference Board measure of consumer confidence that came out this week. There's a measure of kind of jobs hard to get, less jobs plentiful. That did actually improve, but it's still at a level that kind of historically is consistent with the unemployment rate rising further. So, that's kind of not necessarily encouraging, but doesn't necessarily say the labour market's worsening. In terms of the job cut announcements, it's always quite hard when we get these announcements to kind of, again, to separate signal from noise. So, for instance, UPS also announced some major job cuts, or at least that was the headline. But when you read the kind of details closely, most of those job cuts have actually already happened in the first half of this year. It's just confirming that they happened. Amazon, I think, it's a bit more of these job cuts are coming, but obviously they could be spread across time and across different areas. So it's not necessarily the case that they're going to suddenly weigh on payrolls. In terms of what's driving some of these job cuts, there's been a lot of attention on AI, and I think AI is certainly a part of the story. But the academic studies that have looked at this in detail in terms of actual very detailed occupations and age groups, they've generally found that software engineers, unsurprisingly, and also actually retail workers in kind of call centers and support roles have been most heavily affected. Yeah, when we look at the official payrolls data, software publishers have actually increased payrolls this year, and likewise, so has the retail sector. So it's still this much broader story, the slowdown in hiring. And I think it's more to do with both the slowdown in immigration that we've talked about before, but also just cyclical weakness. So yes, we do still have, certainly in Q2 and most likely in Q3, very strong rates of total GDP growth, but it's being driven disproportionately by the sectors that are related to AI. We'll be writing more about this in an update next week. But when we look at the information sector, it's kind of driven 40% of the gain in GDP in the first half of this year, but it only accounts for 2% of employment, whereas the other sectors that account for much higher shares of employment have really been struggling. So that overall healthy GDP picture at the moment masks this kind of very narrow breadth of growth currently. So, where does this all go is the key question, I guess. We're still of a view that as policy uncertainty eases, we've seen tariffs on China dropping back a bit now. As interest rates come down a bit, well, we've obviously already seen the fall in longer term borrowing costs. That should help to drive a bit of a broadening out of economic growth and ensure that these layoff announcements don't gather pace. And instead, we see payrolls eventually pick up, although probably not until around the middle of next year.
And talk more generally about the health of the American consumer. Consumer confidence surveys don't suggest that they're in a particularly good mood, do they?
No, not at all. But then that certainly has been the case for some time without, until recently, any noticeable effect on consumption growth. And even in terms of consumption growth, we have seen that picking up in the most recent data available up to August. And then we do get some, again, kind of alternative indicators suggesting that retail sales rose again in September. So I think it's very much the case that the sentiment indices are still disconnected from actual spending decisions at the moment. So we're not too concerned there. I mean, it's likely that consumption growth is going to be more moderate in the coming quarters, but given that wage growth still remains quite solid and given that households are also benefiting from asset price gains, we think those factors are more important than the kind of a slower hiring in terms of what it means for consumption growth.
Okay, so December's FOMC meeting, I think you said we're leaning towards the idea that they do cut in that meeting. What about 2026? What's the path of rates heading into next year?
We've had this more hawkish view than certainly the markets have been pricing in. And I think, if anything, the key message from the Fed's meeting was it's kind of leaning towards a slightly more hawkish view now, and it's probably not going to cut by as much as markets are pricing in, because we're not seeing much of an effect from tariffs on prices. But the whole argument to begin with was that the Feds could probably afford to look through that, even though it needed to be cautious. I think the bigger story is going to be that this AI boom is going to keep the economy in a healthy position, as well as the slowdown in immigration is going to ensure wage growth doesn't slow too much. So there just won't be any reason to expect inflation to come down. So I think now the Fed's cut the policy rate, whether it cuts by another 25 basis points in December or not, it's cut the policy rate closer to a neutral level. And given that, it's probably going to be happy pausing for some time before it thinks about cutting again. So in our view, there'll be kind of at least a 6-month pause in the first half of 2026. We then penciled in kind of a token rate cut in June once the new Fed chair starts in that role in May. It's questionable whether one person is really going to make a huge difference to obviously the 12-member voting committee, but we do think there probably will still be just about enough support to bring in rates a bit closer to that kind of median neutral estimate. So rates are currently at 3.75 to 4%. They'll be 3.5% to 3.75 if the Fed cuts again. The median neutral estimate is 3%. So one more cut would still take it closer to that level without actually taking it to that level. So it seems like a sensible baseline for now, although obviously there's still risk in both directions.
You don't think the clearer risk is downside on rates? As you say, Powell's, the term ends in May. Trump's made no secret of his desire to put someone in there with more appetite for rate cuts. How would Trump get the much lower rates that he wants? He wants rates at 2%, doesn't he?
Yeah, exactly. Part of this is that we suspect that come middle of next year, Trump won't actually be quite as keen for those rate cuts, or at least he'll see the reason not to push too hard on that. So obviously at the moment, when we've just gone through another recession scare, early hiring is still very weak. There's all this concern about the labor market. You can see why he's calling out for rate cuts, because he certainly doesn't want the downside risk to the economy and labor market to materialize. But if we're right that economic growth is actually going to start broadening out again, so that payroll starts picking up again, and that inflation isn't going to pick up any further, but will remain above 3%, and I should say at the same time, and if the S&P 500 also keeps rising as we expect amidst this AI boom, then the case for rate cuts by the middle of next year is obviously going to be even lesser than it is currently. In terms of the influence, so we've got kind of two Fed appointees already in Christopher Waller and Michelle Bowman, who may be willing to kind of still lean a bit more to Trump's way. We don't know yet whether Powell will leave. Typically, we've assumed, so even though his term as chair ends, he could remain on the board. I think it's for another couple of years until his term on the board ends, and in which case that would obviously be one fewer person for Trump to appoint. But even if we assume that he leaves, then together with Stephen Myron's appointment, that's kind of four leaning at least to Trump's, maybe two of them quite overtly to Trump's view. But then obviously that means it's only 4 of the 12 where Trump has a lot of influence. And one thing I think I'll be watching out for in the coming meetings, now that we've seen this dissent from Schmid, is whether the rest of the FOMC will also feel a bit more free to dissent. Now we're coming to the kind of the sunset of Powell's term, as it were. So there's always been this impression that Powell's really tried to get that consensus and actually keep a lid on dissents compared to previous Fed chairs. But obviously now he's kind of, the end of his term is coming into sight. The other participants may feel a bit more free to assert their own authority and make a point that they're not going to vote for these rate cuts if they don't see the reason for them.
Discipline breaking down on the FOMC is quite the headline. Before you go, I was wondering if you could take off your US economist hat and put on your Canada economist hat, because there's an interesting contrast, I think, in terms of our view of the Fed not cutting next year as much as markets are pricing, and the Bank of Canada, actually, you think it's going to have to cut far more than the bank itself seems to think. So talk through that view.
Yeah, so we also had the Bank of Canada's meeting this past week where it cut by 25 basis points to 2.25%, which that's significant because it's the bottom of its neutral range estimate, which is 2.25 to 3.25%. And the crucial thing was that the bank told us that it now thinks it's done enough to support the economy during this structural adjustment from changes in US trade policy, while ensuring that inflation doesn't kind of rise above target. You know, it's always risky to go against a central bank when it gives such an explicit signal as that. But we think the bank is really just misjudging the situation. So, and in particular, fighting the last war, it seems extremely concerned about risking a repeat of the post-pandemic situation, where obviously policy was kept far too loose for far too long. And it's making these comparisons with the potential supply disruption from US tariffs with the supply disruptions we saw during the pandemic. But we think the far bigger issue this time, you know, it's not the case that manufacturing production has been shuttered. It's certainly not the case that services have been closed due to lockdowns. We haven't really seen much of an immediate impact on supply in Canada. The far bigger issue is that there's been a huge demand shock from a reduction in exports to the US. That's feeding through to much weaker employment. The unemployment rate is over 7% there now. and it's likely to continue to weigh on the economy. So I think as it becomes clear that this is more about a demand story than it is a supply story, the bank will be forced to cut interest rates again. Now, it's not going to do that anytime soon, but we've kind of given it 6 months, we think, to start to see some of this more, kind of a bit more downward pressure on inflation. And at that point, we think the bank will start resuming interest rate cuts in kind of the second quarter of next year.
Stephen Brown on the Fed driving through fog and the Bank of Canada fighting the last war. There's analysis from both of those central bank meetings in the podcast notes, as well as a recording of a drop-in. That's one of our short-form online briefings that was held just after the ECB decision on Thursday to run through what has been a very busy week in central banking. There's more drop-ins in the coming week, including a session on what our EM financial risk indicators are saying. This is a sort of early warning system for EM sovereign, FX, and bank risk. And I will be talking with the EM team about where's flashing red and where they've been seeing improvements. That's on Wednesday at 10 a.m. New York, 3 o'clock London. It's bookended by a session on Tuesday about the UK housing outlook and on Thursday by the UK team's post-Bank of England briefing. Details of all of those drop-ins are on our events page, which I will also add to the podcast notes. And remember, CE Essential and CE Advanced get you access to all of our drop-ins, along with all of our written analysis, tools to engage directly with our economists, a growing suite of proprietary data sets, and much more. Get in touch to learn more about how Essential and Advanced can help you navigate global macro and markets. Drop us a line at sales@capitaleconomics.com and we can get you set up pronto. Now, along with the Fed, the week's other major news was a much anticipated meeting in Korea between Donald Trump and Xi Jinping. We'd already discussed before in this podcast about the likelihood of the US and China finding an off-ramp from recent trade tensions, and it looks like they found it and took it this past week. The outcome of that meeting was a one-year agreement that includes a host of concessions on either side, including lower tariff rates, suspended port fees, a shelving of China's controversial rare earth export controls, and some soybean purchases. Although the mood music from both sides was very positive, our China team has been warning clients that much could go wrong here. To find out what could go wrong, I spoke with Leah Fahy from our China team, and I started by asking her whether this truce is going to hold.
That's the key question, isn't it? Obviously, it's definitely an improvement that things have gone from kind of this 90-day rolling tariff truce situation we'd seen for the past few months into this one-year pact. That said, I wouldn't be too sure that we're going to see the whole year out. If we think about just the last trade truce that we had, we didn't even make it to the 90-day mark before we saw this rapid escalation in tensions over the past month or so. It's clear that kind of the smallest thing can really throw these sorts of truces off kilter. So I think we'll be watching it quite closely.
What was agreed? I mean, it was certainly pitched as Trump gave it a 12 out of 10. He said it was amazing. Not really much progress, though. If you look at the details, a lot of what was agreed was about shelving actions that have come into play as tensions have risen. So the US entity list of barred companies that was expanded, that gets reduced. The rare earth controls, they get put on ice. Reciprocal port fees, those get dropped by both sides for now. If things do go wrong, as it sounds like you're predicting, where could they go wrong? And presumably if they do go wrong, these things then come back into play, don't they?
Yeah, definitely. I think when you look at the actual bones of the agreement, there's not loads of room for error in terms of the actual things that each side has agreed to. So kind of on the Chinese side, they've agreed to more soybean purchases over the next year, but the amount that they've agreed to is less than the amount that they purchased the previous growing year. So it's not like they're going to struggle to meet that commitment. The 1-year delay of the rare earth restrictions, similarly, it's either you do or you don't. And it looks to be the same from the US side. I think the bigger risk is that you have some sort of announcement from either side, really, that the US, for example, sees as having been in the works for a long time. I mean, the expansion of the entity list was one such example. But then when that comes into force, you have the other side reacting, seeing it as an escalation in trade tensions and then all these other issues that we had kind of tabled boiling back up and coming to the fore. So yeah, I think it'll be kind of small, well, what seems like small bureaucratic issues, but that have bigger knock-on effects that could come from kind of any corner of Washington or Beijing.
Let's imagine that things go okay. What has agreed? Does that provide any economic relief for China? The big data releases of the past week have been our own China activity proxy. You led the publication of that, the refresh of that data series. But we've also had PMIs for October, official PMIs. Putting those together, what's the macro message, and does the dial shift as a result of the relief that comes from this deal?
Yeah, so obviously the headline on that front has been this 10% cut to US tariffs on China. Now, that obviously sounds like a positive, and it is to a certain extent, but I'm not actually sure how big of an impact that'll have on China's growth outlook overall. So when we look at our China activity proxy, which, as you say, we published earlier this week, China's economy has been pretty weak for much of this year, but it hasn't actually slowed since US tariffs came into force. So it's mostly kind of more domestic issues dragging on growth there. The PMIs paint a slightly different picture. It looks like growth in October, particularly in the manufacturing sector, did slow potentially partially due to US tariff drags. But I think the bigger picture is that there's been quite a few offsetting factors so far. So, the depreciation and the trade-weighted exchange rate has helped boost China's exports to other countries. And we've also seen some rerouting as well. So the overall picture is that, look, China's exports have grown by less than they would have otherwise, but we think it's probably been around a 2 percentage point hit to what we expected to be around 6% growth this year. So in aggregate, what that means, particularly if we see kind of a strengthening of the renminbi on this good news, is that really there might not be any impact on China's economy this year. I mean, 0.1% boost to GDP at best, I think, is what we're looking at now. I think the other point worth mentioning is obviously this entity list issue. Now, estimates had suggested that the affiliates rule that the US had imposed kind of late in September had expanded the number of Chinese companies that were subject to US entity list restrictions from around 13,000 to something like 22,000. Now, obviously, that's quite crippling for Chinese companies. It essentially bars them from importing any goods from the US and most of the US's allies. So that'll definitely be a big positive for a lot of Chinese companies. And bearing in mind, these rules are supposed to come into force again in a year's time, but it'll at least give them some time to diversify their supply chains and potentially restructure so they don't fall under the jurisdiction of the rule.
Talk a bit more about that rerouting issue. Does lower tariffs change the behavior of exporters? What have we seen in terms of rerouting? How do we expect that to develop?
Yeah, so to start, when we talk about rerouting, what we're thinking about is kind of two distinct types. So one is kind of your outright rerouting. China exports a good to a third-party country like Vietnam, where they whack a made in Vietnam label on it, they send it on to the US. But we also have this broader sense of rerouting that encompasses shifts in trade flows. So suppliers in Vietnam shifting to serve US demand that had been served by Chinese manufacturers, and then those Chinese exporters filling that gap left in the Vietnamese domestic market. Now, what we've seen so far is that rerouting has picked up since US tariffs came into force, but it's only offset around an eighth of the hit to China's exports to the US so far. And that's a bit delayed because we're obviously missing more recent US data due to the government shutdown. But I think what we're going to see over the coming months is that rerouting actually continues to pick up despite this cut in US tariffs on China. I mean, the key thing there is that tariffs on China are still much higher than those on most of the rest of the world. So that leaves significant incentive for rerouting. And I think when we're thinking about rerouting in the sense of this broader shift in trade flows, that does take some time to materialize. Supply chains adjust, factories in third-party countries can't kind of overnight start serving US demand instead. Even if it's almost the same exact good, there are some changes that have to be made kind of even in those final stages of manufacturing. So I think during the last trade war, we saw rerouting offset around a third of the fall in China's exports to the US. And we're looking at seeing around a similar offset this time as well.
And then one of the sort of the outstanding uncertainties, one of the sort of the known unknowns that is unresolved by this meeting is this question of access to semiconductors, specifically to these high-end NVIDIA chips that are very much driving the rollout of AI technologies. Trump went into the meeting suggesting that he was going to talk about them. Turns out, actually, they weren't tabled in the meeting. But it's still clearly a live issue in Washington. A lot of debate, a lot of controversy around this idea of the US offering these chips to China for sale. What is the Chinese perspective on this question of having access to these very high-end chips? Because the last we'd heard, back in September, Beijing was basically instructing companies not to buy the H20 NVIDIA chips, even though the US had, after a bit of back and forth, had finally decided to allow the sales of those chips to China. So how is China viewing this debate over the Blackwell chip?
Yeah, it's a really interesting one because, as you say, there's been this kind of backlash from China's leadership where after all this time of wanting these chips, they've essentially told companies to not purchase them. I think the point I would highlight there is that the H20 is NVIDIA's kind of China-tailored chip. So it complies with US export controls, which essentially means that it's massively dumbed down from the top NVIDIA chips. And, Chinese chips still significantly lag top US ones. But when you compare kind of the top Huawei chips with this H20, there's a lot of metrics that the Huawei chips are actually better on, and those that the H20 leads on, that gap isn't that significant. So there's really less incentive for the Chinese leadership to kind of latch onto those chips and take them in, especially when they're trying to protect domestic manufacturers and drive kind of this broader self-sufficiency in high-end semiconductors. Now, when it comes to the US's broader export controls on NVIDIA chips, we did have Trump saying essentially that the Blackwell chip, which is the top NVIDIA chip that exists right now, wasn't discussed in the meeting, but that China is set to talk with NVIDIA further in the months ahead. So that does suggest that there is some potential for an easing of US export controls, even if it doesn't include that top chip. And I think what that opens up is a wide range of possibilities in terms of the scale of US chip power, essentially, that China can get its hands on. Now, it's pretty difficult to say what the leadership would do if it does get this option to start importing higher-end US chips. But it does leave it having to decide in this trade-off between essentially allowing the import of chips that could help massively accelerate domestic AI development. But then the flip side is their desire to protect domestic manufacturers and boost domestic chip self-sufficiency. And I think the other point I would add there is that Chinese chips still lag US ones, but that hasn't done loads to constrain China's AI development so far. So, we look at a broad range of metrics across the board, and it looks like Chinese models have been rapidly catching up despite this chip lag. So it's definitely a difficult decision for the Chinese leadership to make, and it's difficult to know which they'll end up prioritizing.
But presumably, if the big picture vision is this idea of technological self-sufficiency, that would argue against.
Yeah, and that's what we got out of this most recent 5-year plan, right? The bare bones that we've gotten so far have made it pretty clear that domestic self-sufficiency is going to be the key priority of China's leadership, even if it comes at the cost of the economy's growth and potentially even AI development.
That was Leah Fahy on Beijing's attempt to balance its drive for tech self-sufficiency with its desire for the hardware at the bleeding edge of AI development and this US-China trade truce. We've got a large and growing body of work about how AI is reshaping the global economy and the market returns associated with all of that. It includes our proprietary AI Economic Impact Index, which I will link to in the notes, along with Leah and the team's take from the Korea meeting. But that's it for this week. We will be back next week with much more from the front lines of global macro and markets. Until then, goodbye.